Hey everyone, happy Thursday, December 18th. It's about 10:30 in the morning on the West Coast. Time for another market update. Also, my beautiful wife Corinne's birthday. I don't think she's a realtor. I don't think she watches these. She just hears me ramble on at home about it, all this stuff. But happy birthday to Corinne. Getting right into it, it's an important week in the markets. We had a lot of important data. We got jobs data, inflation data, and like we talked about, that's the most important stuff the Fed's looking at. So let's take a look how things went. Going back to last week, or earlier this week, we got the October and November combined BLS jobs report. You might have seen this in the news, and what it showed was, jobs. There were some jobs created in November, but unemployment ended up climbing. So, looking, like I said, this is a combination because of the shutdown of October and November's numbers. So, for the business establishment survey, where they do some fancy math and figure out how many jobs they think were created, they showed a negative 105,000 job loss in October, which is a big number loss. Been nice to get it back then, and how the markets reacted to that, but getting a little dated now. And then November, they showed 64,000 jobs created versus a 45,000 estimate. So a little bit higher than an estimate, really held up by basically all the jobs were in healthcare, which is not really, economy dependent. So in recession, healthcare, it depends more on our aging population, people being sick, not what's going on in the economy and things like that. As you can see in the month of October, that birth death model where they try to come up with how many new employees were created by small businesses starting, added 413,000 jobs, which doesn't make sense. Probably will be adjusted down at a future date. If you take that away, it was negative 500,000 jobs lost in October. Keep in mind, some of that was government layoffs because of the shutdown. People that were on payroll didn't go off payroll until that point. But that's again a big number of job loss. And then, like we talked about, they did a bunch of revisions. Previously, August was at 22,000 jobs created. They negatively revised that down to negative 26,000. Once again, it would have been nice to get that number in August and not this positive number. And then September, we got 100. It was 119. They revised it down to 108. So it doesn't paint the prettiest picture of the job market. Second part of this survey, we only got this for November. They didn't do the household survey for October. That's when they actually call folks and find out what's going on. And that is the one that you might have seen on the news. Unemployment jumped to 4.6. It's actually 4.56, but they rounded up. The reason that happened was there was only 96,000 jobs created in that time from September to November, but 323,000 people rejoined the labor force. So again, unemployment rate jumped quite a bit. We'll look at a graph here in a second about that. But the other part about this, full-time work in that time dropped by almost 1 million jobs, 983,000. Part-time work jumped by over 1 million jobs. So just me, but if less people have full-time work and have to work part-time or have to work two jobs to make ends meet, that isn't the strongest sign of a great economy, just moving forward, and not the greatest sign for the jobs market. And then, like I said, here is the unemployment rate in graph form. So as you can see, it hit that 4.1 number in June, and since then, it has gone up and up and up and up. So now we're at 4.6. Again, don't want to see people lose their jobs, but this is the kind of stuff that the Fed pays attention to and says, hey, unemployment's rising. We don't want to go into too big of a recession, so maybe we need to cut rates more. So that is why we pay such close attention to these numbers. Next thing we got today was November's CPI. So this is inflation number. It's not the Fed's favorite, which is PCE, but it does come out first. So it's kind of like an early indicator of what maybe we're going to see when we get that PCE. And this came in lower than expected. Again, all positive news. Oops. Back a couple, all positive news. So headline came in at 2.7. So that's basically everything, about 2.7%. You can see it coming down. And the core came in at 2.6, both lower than expected. Both month over month numbers were lower than expected. The best thing that came out of this was there was really good shelter readings. We've talked about that in the past. That's the number, basically how much it's costing people to live in this country, and that's been inflated for quite a while, more than other metrics are showing. So we knew that was lagging data, and that's starting to turn in our favor. So that this was a really good report, because now the Fed can look at both jobs numbers and inflation numbers and see job market's getting weaker, inflation is moderating or coming a little lower. That lines up for them to cut rates, which is what we want. We want them to cut rates and continue to cut rates. Next thing. So this was interesting. So Pulsenomics and Fannie Mae come out with their home price expectation survey every year, which basically looks at a bunch of top economists and looks at what they think, where home prices are going to go this year, next year, and so forth moving forward. And the two numbers I wanted to point out here, because it's obviously a little small, 2026, the median, everybody is at 2.4% gain. And the 5 year, if you bought a house this year, in 5 years, they're saying the median, what the average, what or not the average, but the median is 20% gains. So what does that mean? If you bought a $500,000 house in 2026, you would gain $12,000 worth of equity. If you bought a $500,000 house in 5 years, you would gain $100,000 worth of equity. I know everybody wants a lower rate, but just everybody needs to keep that in mind. This $12,000, you can get let's say you wait for rates to come down, you get $100 less payments, you're saving $1,200 a month. But if you wait a year to buy, you lost out on average about $12,000 of equity. $12,000 is bigger than 1,200. Just saying. So everything, realtors, people looking to buy, just kind of keep that in mind that if you can afford it, better to buy now and take advantage of all that equity that you gain over time. Next thing, initial jobless claims came in, again, very moderate numbers. Estimate was 229, came in at 224. Same story as before. It seems like companies are trying to hold on to employees. Once they do get laid off, it's taking longer and longer to get a new job. So continuing claims continue to stay at elevated rates. Next thing, so the average 30-year conventional, according to that lender survey for really top-end borrowers, is at 6.22 today. It was at 6.27 yesterday. The CPI number made us come down, 0.05. Again, we're kind of hanging out in this kind of range. We're kind of down to 6.25. Obviously, for it to keep coming down further, we're going to need more and more data, and for the Fed to cut their rate at their next January 28th meeting. So next week, a couple days before Christmas, we get the PCE inflation. So hopefully that kind of lines up with the CPI number. And then we get another BLS jobs report in early January, probably another PCE report right after that. And then we will get that Fed meeting on January 28th and to decide what they're going to do next. Right now, it's the expectation is they're not going to cut their rate. But if we keep getting inflation like this and job numbers like this, probably going to change their mind pretty quick. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, I'll come to you guys a little bit early next week since we got Christmas on deck. Have a great week, everybody, and talk to you soon.